The amount of gold coming into the COMEX, the largest deliveries in the history of the COMEX in the May contract, over 16,000 contracts. That's $5.3 billion worth of gold delivered in the May. That's over a 700% increase year over year from this time last year. But this is every single month we're seeing it, and it's not stopping. And I think you're seeing a lot of players that are choosing physical gold in your possession, which is outperforming the bond market as an alternative to it. It's not just here in the United States, it's everywhere, and even in places like Japan. So yeah, this is just beginning. We'll see how it all plays out. Belief that these types of issues will always be resolved and papered over, and they always have been, I guess, maybe until they're not. But right now, these are certainly interesting times.
The speaker, Andy Schectman, explains that over 16,000 gold contracts worth $5.3 billion were delivered on the COMEX in May, marking a 700% increase from last year. This surge in physical gold demand is happening globally, not just in the US, as investors increasingly prefer gold over bonds. The trend reflects a lack of trust in paper assets, especially as US debt has been downgraded, further weakening investor appetite for American debt. The speaker warns that while past financial problems were always patched up, this time might differ. Analysts Vince Lanci and Luke Gromen suggest the gold market recently came close to a major crisis. They believe the COMEX was nearly overwhelmed by physical gold delivery demands, prompting behind-the-scenes panic. Bullion banks, short on gold, were bailed out by significant funds that sold off rather than pushing for delivery. To prevent a meltdown, the market became liquidation only. You could sell, but not buy. They say the US government may have demanded large gold deliveries, forcing banks to scramble. Global demand, especially from China, is rising, signaling deep stress in the paper gold system and a growing preference for physical metal. Andy Schectman, the president and CEO of Miles Franklin Precious Metals, explains that the US dollar has already lost 9% of its value, raising doubts about its future as the world's reserve currency, especially amid rising debt and interest rates that don't match the dollar's decline. Countries are losing trust in US treasuries due to excessive debt, sanctions, and tariffs, and they're seeking alternatives. Japan is facing a similar situation, holding over half its bond market and struggling with the same "who will buy" problem. The unwinding of the carry trade is worsening things, and the Fed's efforts to prop up the bond market are failing. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
So yeah, I think that the price or the ratio is irrelevant. One thing I wanted to mention, I was looking at, Vince Lanci has a very good take on the markets, and I was looking at a string of texts between him and Luke Gromen and talking about. Vince is basically saying that we were that close to a major international regulatory crisis, and it was averted. And he says, now it makes sense. I want to read something to you and give all the credit to Vince and to Luke, but I think people should hear this because it's really kind of crazy if it's true. He says, the COMEX delivery that was shut down, the extended shell games of metal going on for months, the seeming liquidation only behavior, meaning they basically got together and said, no buying, fellas, no buying, only selling. And I don't know if that's true or not, but he says the seeming liquidation only behavior, bullion banks covered shorts and funds sold. Normally, funds would not let the banks off the hook. This market became liquidation only. It was so bad. Have been involved on both sides of the table with those. It's a lockdown, circle the wagons type panic. We came close to a serious problem. It was near a meltdown in the gold market. Physical gold wasn't available to meet delivery promises, so major players scrambled behind the scenes. Bullion banks were in trouble. Big funds bailed by selling, letting the banks off the hook. The market got so shaky, they made it liquidation only. You could sell but not buy. It was full panic mode, but they managed to patch it up before it blew up publicly. It shows the system isn't as solid as it looks. If people can't count on getting real gold when they want it, trust in the market could break down. Going forward, more investors might avoid paper market and demand the real thing, blah, blah, blah. Now, Luke Gromen says, now imagine what happens if it was the U.S. government bringing the gold back, and the response to all of the above talking about the banks, from the U.S. government is F you. Send us more gold this month. You know it. Bullion banks to cover the Treasury, calling it back, or the Department of Treasury itself. It most certainly was. So here you have two of the smartest guys on the planet, more or less saying that we're this close to watching the whole COMEX blow up because of all of the delivery requests. Well, who's standing for delivery? Over 16,000 contracts so far in May. He's saying it's the government. And the government says, I don't care how stupid you are that you're short. Give me the gold. And he says it was just narrowly averted. At the same time, we see China, their gold imports into the country were 127.5 metric tons for the month, an 11-month high. The world is continuing to ask for delivery. This is where everything breaks. This is how everything breaks. And if you go back to 2020 and I started talking to you about the deliveries off of COMEX, it started then and it's accelerating now. And since 2020, it's been a common theme. Prior to 2020, it was a never theme. No one stood for delivery. And when you see the LBMA go from T+1 to T+8 weeks, when you see a guy like Luke and Vince say this was a disaster averted on COMEX and it's the U.S. government standing for delivery, things are starting to come into focus. And the rest of the world understands this. And that's why you see them at the same time standing for delivery. Things are getting really, 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 really interesting as far as I'm concerned in the gold market. The resilience, and I think silver's not far behind. You look at the technicals, they're identical, with the exception of gold has broken up through the handle. Silver is right there at the technical resistance level. But look, what is different to me is that you have willing buyers throughout the world standing right underneath the 200-day moving average. And if they are foolish enough to use their bullets to suppress it, you have people standing there, countries, sovereign wealth funds, central banks saying, okay, we'll buy it and we'll stand for delivery. And you're seeing this. This is a wake-up call to the participants of the gold market and to those that are silly enough to be naked short. You know, our dollar's lost 9% already. So how do you run a world reserve currency with all of this debt, with rates that are not commensurate with the falling of the dollar and the debt accumulation? No one wants to buy it, let alone the way that we behave with these countries, threatening them with sanctions and tariffs. They're finding alternatives. They truly are finding alternatives, and it's becoming very obvious to me. So yes, that is the playbook, come in and rescue the day. But if they do that, where's the credibility and where is the demand for treasuries when you look at a country that is resolved to never normalizing their balance sheet? And that's why people are saying that Japan's going to do the same thing right now. After all of these years of suppressing rates, the Japanese government owns 52% of the bond market. Well, you know, where's their credibility as rates go higher in an attempt to normalize their balance sheet and sell those treasuries into the market? They too have the who to problem. Who do they sell them to? Who wants them? Everyone else is gone. And we're beginning to witness a similar pattern here where the big buyers of our treasuries are moving in the other direction. And you take away the carry trade, rocket fuel, where people can borrow money in low priced yen and then convert to dollars and buy Nvidia or Bitcoin or Apple or treasuries at that spread. Now that's disappearing very quickly. The unwinding of the carry trade can be just as viciously bearish as the ability to use the carry trade. So yeah, these are dangerous times for certain. And I think it all is going to be centered around the debt markets, which are far bigger than anything else, far bigger than the Federal Reserve has the ability to contain. And we can see that by them coming in and buying the 3, the 30, or the 3, the 10, and the 30, and the rates are still climbing even with that participation by the Fed.
Andy Schectman, in an interview at Commodity Culture, highlights that common U.S. coins made of base metals are essentially worthless, reflecting the dollar's declining value, which has already fallen 9% this year. While a weaker dollar can help exports, something Trump supports, it also discourages other countries from buying U.S. treasuries and dollars. Years of artificially low interest rates have caused severe market distortions, and now that rates are rising, asset prices could crash back into reality. The US has benefited from its reserve currency status with cheap imports and strong asset prices. However, reversing that system by reshoring manufacturing and weakening the dollar has painful consequences. Meanwhile, demand for US debt is fading, threatening the financial foundation we've relied on for decades. According to Schectman, the opportunity isn't just in physical gold, but also in gold-related stocks and ETFs. The gold market is so small that a few billionaires could buy up the entire US retail supply in a single day. If the public suddenly awoke to gold's value, supply would vanish instantly. As prices rise, countries that mint gold coins, like Krugerrands or Britannia's, may keep that supply for themselves rather than export it to the US. The speaker acknowledges they may be early in their warnings, but believes the math doesn't lie. Global appetite for US debt and dollars is waning, especially with trillion-dollar deficits and debt ceiling battles looming. Now, let's dive into the interview.
The common clad coins are just junk. They're not worth anything. And so, no one's going to buy them to melt them down. So, yeah, I mean, that's the currency. If that's the case, the currency falls as the currency falls. And it is falling. I mean, and it's falling, fallen 9% this year. So that's what President Trump wants, of course. And that's, you look at the Mar-a-Lago Accord, it speaks of a weak dollar. That's what they want. That's what he's getting. But now you're going to run into problems with who wants to take our treasuries in that environment, who wants to take our dollars in that environment for the goods that we sell, or that we buy, rather. So, this is the quandary. This is what happens when you mess with Mother Nature the way that we did, and you suppress interest rates for 2+ decades, creating distortions and misallocations in resources and capital, and distortions in asset prices. When things try and find equilibrium with reality, especially in a rising interest rate environment, the biggest shock to all will be the asset prices that regress to the mean. So, this is part of the reason he wants low interest rates and low, a cheap currency to help our exports and whatnot. But remember, it is because of the reserve status that we have low interest rates and that we have cheap goods and that we have high asset prices, because the world has been buying our currency, which makes our currency strong. This is Triffin's dilemma. And you will always have strong currency as the world reserve currency, because there's greater demand for it than we can supply through commerce, just simply people buying our stuff, or vice versa. And so then you end up with a situation where it's so much cheaper to send your manufacturing across the world to the countries that are inexpensively producing it in their cheap or their inexpensive currency, that you eviscerate your manufacturing. This is why we have trade imbalances, and it is for that. And is it unfair? I don't know. Is it? Is it unfair that there are tariffs by these other countries when we get the benefit of being the world reserve currency, which has enabled us to live high on the hog and have low interest rates and high asset prices and cheap goods? Well, you reverse that. And I agree, we need to bring this stuff home. There's no easy way to do it. We have to. But it'll be a process whereby if it reverses, now you have high interest rates and goods that are more expensive, shelves that are half full, Wall Street that is seeing falling prices, companies that are making layoffs. You don't have the benefit then that we've enjoyed for a very long time. So it's a double-edged sword, and I don't know what the right answer is, but I will tell you that you can tell that he's certainly agitating a good portion of the world with these ideas, and at the same time, we're witnessing in real time how the bond market is just losing demand from the people that have supported our indebtedness and our spending for the last 50 years. When you ask Rick about that, he'll say it's gold and gold related equities. So it's not just gold, it's actually gold and gold stocks and ETFs. I mean, it's nothing. And that's why I've always said that this market ultimately, in my mind's eye, will be defined by an inability to readily source product, because it is such a small amount. And if anything happens that would wake people up, the mainstream, in a few hours, everything would be gone. I mean, that's the truth. Eric Sprott and Rick Rule and a couple other people could empty their wallets and buy up the whole industry in an afternoon. As silly as that sounds, they could. I mean, if you had a few $1 billion thrown at the retail market in this country, and then you get to a point you have to wonder at some point if we see this thing unfold, where gold really starts to move higher and silver really starts to move higher, and it'd be better to keep it onshore, to become more nationalistic, rather than to, better hurry up and get it now. But I think these are things that I think about all the time. And again, I'm the little boy who cries wolf, but I do believe what I say. I just, have a bad habit of being way early on these things, but I do think they will happen. It's all about math at this point, and the math of where we are just doesn't add up to the rest of the world being keen on holding our dollars or holding our treasuries or continue to fund our exorbitant lifestyle when we are, here we are, even with Doge, and we're asking to raise the debt ceiling and have another on the horizon $2 trillion deficit. Not a good mix.
The global financial landscape is shifting rapidly, with growing distrust in paper assets and U.S. debt fueling a surge in demand for physical gold. As central banks and investors worldwide move toward tangible stores of value, cracks in the current monetary system are becoming harder to ignore. With rising deficits, waning demand for treasuries, and mounting geopolitical tensions, the era of unquestioned U.S. financial dominance may be nearing a tipping point. Do you think the shift from paper assets to physical gold will accelerate a broader loss of confidence in fiat currencies? How might countries respond if the US dollar continues to decline as a global reserve currency? We welcome your insights in the comment section below. If you found this content valuable, don't hesitate to give it a thumbs up and don't forget to subscribe to stay informed. Thank you for joining us on this journey.